another episode of Policy and Profits. I'm EJ Antoni. I like to play an economist, on TV, radio, that sort of thing. But more importantly, joined by the star of Policy and Profits, the one, the only, Anthony Esposito. He is the trader extraordinaire. He is the founder and CEO of Ascalon 6 Capital. He is the reason everybody listens. So, Anthony, how are you, my man? How's your week been?
Week is good. Week is good. Thank you very much. I love the intro. Thank you as usual. Week's been really good. Very interesting. We had a really it was an interesting comment from Secretary Bessent yesterday, and I know this has been a big part of your week as well. So I'm going to dig right into it. Pre-market yesterday, Treasury comes out, makes an announcement that they're doubling their buying of the long bond from $2 billion to $4 billion. I don't know that that's really a big boost in purchases. I don't know if it was more symbolic or it actually is going to have an effect. I think that I want to go into with you, first of all, what exactly it means and why, the what, why, and the why now. How much of a big deal is this, and why would Secretary Bessent not only make this announcement, doubling that purchasing? The purchasing ends on November 4th, ironically, but then today reiterated that he would be willing to actually buy more. And this comes on the heels of the yen intervention 2 weeks ago. So you have them trying to control foreign currency now, and now you have them intervening directly and openly in the U.S. Treasury market. What is the true effect here? Is it QE light? I know you and I talked about that. Is there any liquidity effect? Is there any real stabilization? What are they doing, and why now?
Yeah, all really great questions, Anthony. And it's just amazing how many people online are, they got their hair on fire. They're like, this is QE, the Treasury's printing money, they're doing yield curve control, this, that, and the other. And pretty much nobody's got any idea what they're talking about. Basically, what Bessent is doing, whether it's this buyback, the previous buybacks, the yen intervention, it's all just ways that they're trying to remove arbitrage from the market. In other words, they're getting rid of these opportunities that traders or investors might have. So with any buyback, just think of it as the Treasury is swapping on the run and off the run treasuries, right? That's all they're doing. And in cases where they're swapping the same maturity, right? A bill for a bill, note for a note, bond for a bond. And again, within each of those categories, the same maturity. The impact is very, very muted overall. Now, in this case, what you're seeing is not only the exchange of an on the run for an off the run treasury, but you're also seeing a big difference in the maturity schedule, in the duration there. So they're getting bonds off the market and they're putting bills into the market. So what does that do? Well, when you increase the supply of those bills, it's going to push up yields. And when you decrease the supply of those bonds, what's it's doing? It's going to put downward pressure on those yields. And that's basically the goal here. So again, they're trying to remove an arbitrage that the market currently has, which is not good for investors. It's part of the reason why I don't like it. It's not a big move overall. It's really not. When you're talking about a couple of $1 billion and you think about the sheer size of the Treasury market, and look, I understand they're not trading all those treasuries at once. Obviously, a 30-year bond, it's there for 30 years. But still, even if you just look at the treasuries that are being traded each day, this is not a big portion of the overall market. It is adding liquidity in a very, very limited sense, though, insofar as you're taking a very illiquid asset, that bond, pulling it off the market. You're putting a more liquid asset, a bill, could be especially a really, really short, might not be a 52-week, it could be a lot shorter duration bill. So in that sense, because you are putting something into the market that is traded a little bit more like cash than the bond was that you took off the market, okay, in that sense, there's a bit of a liquidity effect. Okay. But that's it. This is not the same thing as the Fed. When they're open market operations, not the same thing at all. And I know as far as people say, well, this is yield curve control. Guys, if you look at the shape of the yield curve right now, it's, we're not even in a position where you would say the government would actively want to do that much yield curve control. I think, and by the way, these buybacks are a very poor tool for trying to do that. I think this is literally just, Anthony, all it is is the Treasury saying the market right now is willing to swallow certain durations of debt and it's not willing to swallow any more of others. And so the Treasury is trying to account for that. And again, I don't like it from the standpoint of, they're taking away an arbitrage opportunity from the free market that the free market should have, right? The free market should be sending a signal to the government, you are borrowing way too much. And unfortunately, Bessent now has fallen into the same trap that Yellen herself got into, that she created, where they're running the Treasury like a hedge fund. Yellen, let's not forget, in I guess it was maybe end of 22, start of 23, she really, really takes, really, really comes off on all the issuance of bonds, so 20 and 30 year, and they just start racking up all this T-bill issuance. And the reason for that is they're anticipating rates being lower in 2024. And ironically, they did get the interest rate cuts they thought they were going to from the Fed. We got 100 basis points taken off the Fed funds rate. But what happened to yields? Mm-hmm. They went up 100 basis points. And you and I have beat a dead horse on why that happened. So we don't have to go into it again unless you want to. But I don't want to bore the audience. But again, the point is that they're basically just now in this pattern of, we're just going to issue all this short-term debt and hope really, really soon we get yields to come down and then lock everything in at 30 years.
So, I mean, look, we're at the 2-year at 418 today, back up. The 10-year 4706 back up. The 30-year at 5247 back up. The 2's10 spread is at 52. It was at 54 right before Secretary Bessent made the announcement. So my point is, there was literally no effect. It's like, there's a little GIF or GIF out on X where there's a volcano erupting, and the guy's got a water bottle and little water pistol that you would buy in like Walmart, and he's shooting the volcano in the background to put it out. But all kidding aside, there's been no effect to the market. There was and we're going to show that cut. We could actually go to cut 2, which is the graph. This is the 30-minute of the S&P futures heading into that announcement. We had a 60 to 70 basis point move up in a matter of minutes because of the announcement. Market today, equities wise, futures wise, across the board, well below the low prior to the announcement. Rates back above where they were prior to the announcement. So nothing was accomplished. Why, if it's not that big of a deal, is there something under the surface? Why do it? And I think that's becoming a concern, and we're hearing it from some of the larger brokers. We're hearing it from people on the street. I'm reading research during the day, and it is kind of like, why do it if nothing's wrong? If it's not going to be that big of an effect, you're clearly not moving the needle in the 30-year on the long bond. Why do it?
I think it was mostly it was kind of psychological more than anything else, because like we said before, $2-4 billion, that's a drop in the bucket here with today's Treasury market. We just hit $40 trillion in debt the other day, right? And okay, I understand not all of that is tradable. Some of it's in intergovernmental holdings. Some of it's stuck at the Fed. I get it. Not my point. It's not that much, right? The move that Treasury announced, but I think it was more so an attempt to kind of help the market psychology to say, look, we're going to do what it takes to again get these what are really arbitrage opportunities out of the market so that people can't take advantage of them, and keep that downward pressure on the long end of again the 20 and 30-year bonds. Because I mean, look, when the debt is as high as it is, these interest rates are unsustainable. This is literally exactly what's happened with the housing market, right? That $1 million home at 2%, okay, I can afford that monthly payment. At 8%, nope. Well, guess what? When the interest rate was 2%, and now it's 3.5%, I think, is the average for the national debt, and yields are basically converging somewhere in the ballpark of 5%. Yeah. So if you look at where we are today, 3.5% interest on the debt on average, that's going up. It's on its way up to 5%. It'll take us years to get there because we sold 30-year bonds right in 2020 when interest rates were nothing. So again, it's going to take a while for that to catch up, but that's where we're headed.
Yeah. Well, when we look at first of all, I don't like. And I mean this I mean this as a conservative Christian patriot. I don't like the intervention, and I don't like what is becoming more and more to me feeling like the thumb on the scale. As I move
Yeah.
through my day and I move through my model, and I'm watching correlations, I'm watching price action, I'm watching momentum trend, our momentum trend indicators with price, the correlations and the reliance, these things are not acting the way they normally do. I can personally see a difference in the market. And then you lead into the tweets and you lean into $100,000 per subscription to get, early access to Trump tweets, which you're making it look like market data. The optics are just really bad.
Yeah.
Intervention in the Treasury market to kind of make a statement, because that's really all that happened. Intervention in the yen, in foreign currencies, and because we're friends, these things are just becoming egregious. Early trades in the crude futures, pressing down of the VIX curve and front month VIX, early trades in the equity futures. I'm going back now to February, March, and
Hmm.
through. It's just a lot. It's a lot to handle, and I think yesterday's announcement, where we saw that, it kind of looked like, as we started to take off, I felt like it was the type of thing where we would see, and I'll delve into the profits part here and the markets part. It felt like it was one of those announcements that we had started to cool off. Our model has shifted into a negative for equities. We're positive gold, we're positive crude. So for the equities, we felt heavy, and we thought we were going to be coming in, and we were positioned. So um, that announcement really was, to be honest with you, we kind of sat and watched, but I felt like we were about to get our face ripped off for a 2% rally up. And it's interesting because we didn't get that. So the market,
Mm.
there's more concern on top of the market. The market's heavier. And we can see that with momentum trend, and we can see that with patterns, and we can see that with trend lines breaking. The market's heavier than it was a few months ago, when a headline like that would have been worth 100 to 200 basis points up in the S&P futures. Not
Yeah.
so. In fact, today we're well below where we were before the announcement. So in a quick note, I would say, A, I'm tired of the intervention and the intervening, and the comment, do what we need to do to succeed as a nation. But the markets are free markets. Let the markets. I mean, I understand there's a certain role government plays, the Fed plays, the Treasury plays. That's
Hmm.
fine. But when you're starting to cross over into capital markets, no bueno. I don't like that. And on a similar note, or a separate note with markets, I'd be really careful here with exposure. We're starting to get a little bit of a breakdown in momentum trend. We've been neutral for 7 days in the S&P and 2 days in the Russell. We actually have negative shifts in both of those today, and the inputs there are various, but they've all lined up today. So I would be conscious of a little bounce in the equities coming off of today, but I'd be more conscious of having some exposure short or lighten up on that bounce, because I think we have a little bit more room to go to the downside. Market not reacting to an announcement like that to Bessent in a very positive way and sustained way is showing you there's more concern there. So where's the concern? Well, the concern is yields were still higher. The concern is in the AI stories falling apart, whether you're talking about circular financing or the shadow financing, or you're talking about data centers not being able to be built, a pushback heading into midterm elections against this entire infrastructure build. If you're looking at Iran and the Strait, we still don't have an answer. And the answer we've gotten recently from President Trump is, we're going to strangle them financially. How long will that take? I don't know. I don't think he really cares, but it does make a difference. There is,
Hmm.
now we're starting to see a broadening of the selling within the S&P 500. So we're not only selling chips, we're not only selling Mag 7, we're not only selling high momentum. Everything's kind of getting sold. And I'll push back into one final note. As we look at, one of the things we look at here is the high beta momentum. If we are looking at where we are now, so that flush out of Momo was the problem in July, we've actually reached a lower high in high beta momentum names, and we have about 15% down to go in that group to match the July low. I'm not saying we're going to match that July low, but I am saying that's a downside target for us.
Mm.
So we are looking at a meltdown in momentum as well, those high beta momentum names. So all things to keep an eye on. If we can't recover quickly from what we're looking at today in a sustained way, then I think we definitely have another, not a major move down, but we could be down another 5% from where we are right now. And I'm definitely watching those high beta momentum names. So I appreciate Secretary Bessent's effort in the end in the treasuries, but I don't know if it's going to make a difference in the end. The market is greater than all, I think.
Yeah, I think that's right, Anthony. And especially when the Fed just the other day, actually, they announced they were stopping the reserve management purchases, so they're not gobbling up those T-bills anymore,
Hmm.
right? Maybe Bessent's announcement, but coupled with the Fed still having that heavy appetite for additional treasuries and growing the balance sheet, maybe then you would have seen a lasting impact. But I'm really curious now if maybe we'd have to do some correlation tests here to try to find out how much of this momentum is actually just really based on the Fed adding to the balance sheet, and you take that away. Is that pulling out the wrong peg in the Jenga tower? You know what I mean?
Yep. Yep, exactly. We also have very interesting action in crude over the past few days. We've had a real run up in crude from the went from the high 70s up to the mid 80s. We came back down to the low 80s, and now we're back up. October crude today is up. We're actually up over 2.3%, up at 86.37. We had a high of almost 88 today.
Mm.
So crude is definitely seeing a move. And in fact, Secretary Bessent said today outside of the White House, I'm not sure why crude is going higher. So either he knows, and they're trying to get in front of that with some of these announcements, or they don't know, and there's something going on behind the scenes. But crude is moving higher, and it's moving higher sustainably. It's not moving higher and then fading throughout the session. It's
Right.
moving higher and then grinding in a very uniform way higher throughout the session. So I think we want to be careful of that as well. EJ,
Mhm.
I always appreciate the help, man. Super insightful. At real EJ Antoni, you definitely have a great X handle. I'm on it all the time, and all this stuff's laid out well and laid out graphically and visually, which is awesome because it's not just a read and it's not too much of a read. You get to the point, and the pictures tell 1,000 words. So, thank you for the time and the help, my friend. I appreciate it. I am at CMT_Anthony on X if anyone wants to check out that handle. Thank you, everyone, for joining. EJ, have a great night, my friend.
Anthony, same to you, my man. Great talking to you.
Talk to you soon.